Listen, I've looked at the data, and I do believe there are persuasive economic reasons for the Fed to aggressively lower interest rates right now. I know that Steve just a little while ago saying, show me some evidence, data that shows this. Well, one of the personal consumption deflator index, the PCE index, and that's about 0.3% below that. So really on the PCE, the long-term inflation expectation that the Fed itself uses, that Chair Powell has talked about, they've used this for over 20 years, is now at 2%. So, on that standpoint, I think there's a lot of it. And by the way,
so forget about the bond market. It's a week later. We're feeling good about things, and we should go ahead.
Well, the bond market is, I think the bond market's being disturbed by a lot of things going on, and things about the independence of the Fed and all sorts of other situations. And in fact, I think the Dow would improve actually if Jay Powell actually lowered that rate. Another factor is that money and credit are just not growing fast enough. Over the last year, the M2 money supply has grown less than 4%. For a healthy economy, you need between 5 and 6% money growth. It's actually lower than it was 3 years ago. And the only way for the Fed to actually stimulate loan growth, to stimulate money growth back to a healthy level, is by lowering those interest rates.